Okay, so I'm just going to do a quick video explaining a concept and strategy that a couple of people have asked me about in the last few weeks and nobody seems to understand, so I'm just going to run it through. It's mainly a term that I've heard in institutions rather than in proprietary traders, but it seems to be getting used a lot more on Twitter, so I thought I'd explain how it works. And that's when people say buy weakness, sell strength. And what we're referring to is basically a way of swing trading, mainly. Usually for people building significant positions, but it seems to be being used by quite a few traders I respect who seem to just be, individuals. So I thought I'd give an explanation of what it means. It's usually used when you've got a strong bias to one side. Like, for example, last week we think the market's going to go up and continue going up. We could implement this strategy. And what it really means is that when the market looks weakest and looks like it's going to go down, that's when you start buying. And if the market rips through a certain level when it looks incredibly strong, that's when you sell and look to get in again on more weakness. For example, if we were trading the DAX here tomorrow, so we've got Friday's data here, I've marked out Friday's value areas in purple. So say we ripped up, came down, and front run this a little bit or tested it, and then started going back up. If I was looking to buy weakness, I could wait till it broke back into yesterday's value area. So it looks like the market's going down. I mean, the earlier level hadn't held. So the market is at the weakest it's been in that day. But since I've got such a strong bullish bias, I would be looking to buy into this. And this is why you get a lot of swing failures, in big bull markets. And then say if we came up, ripped through, Thursday's high on massive strength, then I'd sell and look to get back in on more weakness. Say if we broke back into Thursday's range around there, it looks weak, I'd buy it again. And this strategy is what's used by a lot of buy-side traders and hedge funds and things like that. They'll get a range, like, say if it was doing the DAX here, and say we wanted to accumulate a position of 400 DAX contracts, and you want to get them for the cheapest price possible. The cheapest price possible means more bonus for you. So what you do is you just look for the weakest price to buy. So that's why we buy weakness. An interesting thing that this sort of means is, I know a lot of you have seen the 330 ramp, which 330 ramp capital as a joke, where the market tends to rip up at 3:30 New York time. And one of the main reasons for this is that there's always hedge funds and pension funds, big institutional traders who've been looking for the lowest price all day, and they'll have a certain amount to accumulate, say 400 DAX. And they've only got 200. They were looking for more weakness, but now there's half an hour till the close, so they're going to have to buy it. And this is why you see at 3:30 sometimes a massive ramp up as people try and fill their positions and try and fill their quotas for the day. So I thought some of this might be interesting to you.